Welcome back to the InvestTalk classroom. I'm Justin Klein.
And I'm Steve Peasley.
And today we're going to talk about the beginner's guide to investing. And we typically like to start high level, and that is really understanding your risk level, your risk tolerance level. And that's what's most important, is because most people, they make rash decisions. We've talked about that before many times on air, which is people chase returns when things are going well and they bail out when things aren't going well, really typically at the wrong time, right? People tend to buy high and sell low, unfortunately. Right.
And so one of the main things when you first start out is understanding your personal risk tolerance. How much risk do you want to take of the money you're putting in? A lot of people don't want to take a lot of risks. Some maybe based on your personality, you don't. But really, the amount of risk you take should be based on how much time horizon you have in investment. Yeah. The longer you have, longer your time horizon is, the more risk you can take early.
Yeah.
So
and it's one of those things where there are some basic rules, right? The younger you are, the more risk you should take. But that doesn't mean just because you're on the younger side, you should take a lot of risk, right? Because once again, it goes back to your ability to handle that volatility. And when you know yourself, then you can really design a portfolio, create a suite of assets that has the volatility that you're comfortable with over time, that still has good return over time as well. So that's understanding your risk tolerance level and who you are. But there's also risk capacity. So for example, there's a lot of people, they're aggressive investors, they're aggressive people, and their willingness, their risk tolerance level is very high, but they get into their 70s and they're in retirement, right? And do you want to take a lot of risk in that type of situation? Probably not, right? You've seen a lot of investors like that.
If you have multi-millions of dollars, sure, you can take a lot of risk because you have the capacity to take that risk. But if you have, a certain amount of money that generates a certain amount of cash flow income to you, and you can't risk that money too much, you have to reduce your risk level. Even though you might be a high-risk person that you like to take a lot of risk, you still have to look at the reality of your own personal life and your lifestyle in retirement and income that you can generate that's fairly much more conservative than the risk that you could take because you have the capacity to do it. You want to do it.
Yeah. So when you're in retirement, you should probably take less risk, even if you're willing to take more, I think is the long and short of it. Now, the next phase is really, okay, once you understand the type of portfolio you should have based on your risk tolerance levels in your phase of life, it's investing in what you understand. And we see this a lot is people, they read an article, they see something on TV, and they really get into something that they're in over their head, right? They don't really understand the longer term volatility of that asset class or the business, right? What the business is doing well, but why is it doing well? So it's really about understanding the assets that you are holding.
Yeah, one of the worst, and we covered that in the pitfall area, is that you hear a tip from your brother-in-law, your friend down the street. And I have never, in all the years I've been doing this, have ever had a tip work out.
Yeah.
They don't.
And that goes back to the next one, which is understanding your level of involvement. Oftentimes when you hear that tip, it's not really about a fund, right? It's probably some individual stock or, maybe it might be a fund, but usually it's an individual stock. But either way, it takes a level of tracking and involvement. The reason that company might be doing well may be different in 3, 5, 10 years. Are you willing to follow that? And, most stocks, the vast majority of stocks that are out there aren't ones that you buy today, you stick it in a drawer, and you forget about for 30 years, right? No. 99% of them are not. If you just look at the construction of the Dow or the S&P 50 years ago, it's vastly different. And a lot of those companies are bankrupt today, right? So it's understanding your level of involvement and your willingness to track those investments over time, track the business, track the fundamentals, and maybe you don't want to do that. And then it goes down to maybe you invest in some type of a fund. right? And maybe that's a mutual fund, maybe that's an ETF, maybe you hire a manager like us, right, to make the decisions for you. It depends on what you've said many times, which is the willingness, the time that you have to make these decisions, to do the work, and the data and the discipline, which is probably the most difficult part, right? Is having that discipline when you are investing in both sides, selling positions that aren't working out, and once again tracking those over time.
You touched on something that maybe we should talk about a little bit in investing in an index. They've changed over time because of the size of some of the companies in the index. For instance, Apple's $3 trillion market cap, and has, I think, 17-18% influence over the NASDAQ 100, just one stock. 70, I think 92 or 93 of the stocks on the NASDAQ 100 have the same amount of impact, 17%, as one stock, Apple. So you kind of understand what you're investing in, even if you're investing in indexes.
Exactly. It's now the index is weighted towards the growthier side of the market, but post the first dot-com bubble, right, in the mid aughts, shall we say, I think energy was a huge part of the index, right? Exxon was the biggest company at that time. Remember, the S&P's market cap weighted. Exxon was the biggest company. That means Exxon had the biggest.
So if they go up or down, they influence the index.
Exactly. So now, understanding what you invest in is certainly vital. And then it's about rebalancing, right? Indexes rebalance, but you should probably also rebalance your asset classes as well. We see this with people getting overexposed to one part of the market, or one asset class, right? Where in the 90s, you had so many people, especially the baby boomer generation, they really rode that wave of tech investing and the first dot-com bubble, and they got overexposed to equities in the late 90s, right?
Yeah. So when you're talking about the baby boomers, that's me.
Yeah.
And remember the dot-com, I don't know how many current listeners remember the dot-com craze, where everybody wanted to invest in dot-com stocks, and even the quote-unquote experts, Goldman Sachs, Wells Fargo, all the big companies were recommending buying these stocks because those are the stocks who were moving. Fundamentally, had terrible fundamentals, terrible. No one was making any money. Just because you had a dot-com behind the name, you thought that was going to be the winner. Look what happened. Collapsed in 2000.
So that rebalancing on the sector perspective is important as well, like you said, where, if you're in an index, you're overweight the sectors that have been doing well. They're the biggest, highest value companies, but it doesn't necessarily mean that they're the best investments going forward. They're just the highest value today. And that can continue. They can continue to grow into that valuation. That's certainly a possibility. But more often than not, it's better to rebalance out of those sectors that are overweight and too expensive.
So if you rebalanced, you would have been taking profits at the dot-com era. You would have taken profits at the highest price because you're rebalancing away from them because your portfolio got out of balance. But people didn't do that. They held on to them as they crashed in 2000. And all of a sudden, now you're not out of balance because all those stocks died. Many of those dot-com companies went out of business.
Yep, exactly. And that you can say the same thing with on the asset class basis. We talked about equities, but also real estate. Remember, before the financial crisis, so many people leveraged themselves up to real estate prices, right? They bought a home. They were able to borrow against that equity to buy another one and leverage. We got calls, right? Should I pay off my mortgage or should I go and buy this other property? We were telling people, be conservative. Don't have too much debt on your assets.
I remember Justin talking to a potential client come in, and he was talking to us about investing in the stock market, and he had 7 or 8 houses that he would buy, borrowing money from his first house, buy, super over leveraged. And then in 2008, when the housing market collapsed, he lost all his profits because he was so over leveraged in housing. Very conservative investment long term, but short term, they can be very volatile.
And then the next thing would be understanding why you bought it and does that remain today, right? It's tracking the business over time, or it could be tracking a particular investment over time where you're saying, I'm buying this property, going back to real estate, and I'm happy with my 6% return. And if suddenly the prices go up dramatically, you've already kind of front loaded that return. And so maybe it's a time to sell, right? Things have changed. The values change. Your yield to maturity, shall you say, has changed. And then it's time to potentially sell it. So tracking the reason you bought it over time. If a company's doing well today, like we said, may not be doing well 2, 3, 4 or 5 years down the line. Okay.
Yeah. Learning to take profits is very difficult.
Yeah, it is. And the last one would really be understanding your opportunity costs. It's, people buy something, they're down on it. Their nature is to, let's just get even. I just want to get even, right? And more often than not, that stock just continues to go down. They never really get to even. And that opportunity cost of selling that and moving that into a position that is going to do well, right? And is going to outperform. If something has been underperforming, maybe there's a reason for it. Maybe your thesis is wrong. Maybe you want to reassess that, right? And understanding the opportunity cost to take that capital and put it into something else is important as well.
Yeah, one of the things that we, for a beginner, one of the things we recommend is write down the reason you bought the stock. Write it down on a piece of paper. I know that's old tech. Maybe you can write it on your computer, but
or
write
notes,
it down.
Notes app.
Yeah, on your notes in your computer. But write it down. And then when you rebalance your portfolio every few months, you look back, is that reason that you bought it still valid? Did it change? And if it did, is it still good to own it because things have changed? And people don't do that. They just look at, does it go up or did it go down? That really, that kind of is immaterial whether it goes up or down. It's whether the fundamentals have changed, whether it's the prospects of that company has changed or not, or is it the reason you bought it still exist? So it can be challenging.
And fundamentals always catch up to the price.
Yep.
One way or the other.
One way. I remember Apple didn't move for 5 years, and then a couple of years, boom, up 200%. For 5 years, it didn't move. Were you patient enough to hold on to Apple?
Well, that's because Exxon was everyone was investing in energy at that time.
Yeah.
Now it's the opposite.
Just the opposite.
Yeah.
Love energy at this point. Plays great dividends.
Well, thank you all for tuning in. I hope this gave you a good primer on how to invest for beginners. And tune in to the next episode of the InvestTalk Classroom.